Let's quickly solve this question now. We have the question on the screen. Now let's come to our solution. So this is our solution. Okay. Here in this question number 1, we'll be looking at liabilities. The rule is that at any point in time, the asset of the business must be equal to summation of capital and liability. So if we are looking at liability, our equation will change to be L equals to A minus what? C, subject of formula. And here, where, when we saw question number 1, where L is what we are looking for, A is 300,000 and C is 190. C equals to 190,000. So what is L? L equals to 300,000 minus 190,000, and L will equals to 110,000 naira. So here L is 110,000. Okay, question number 2. We are looking for A in question number 2. So solution 2, looking for A, therefore A is what? Capital plus liability. That is the accounting equation. Capital plus liability, where C, we have what C is in the equation. C is a 70. C is 70,000, and L is 140,000. So A equals to 70,000 plus 140,000, and asset will be 70 plus 140, and that is 70 plus 140. That is 210,000. So A is 210. Okay. Then 3. Solution to question 3. What are we looking for in 3? We are looking for capital. We have A to be 130 and R to be 50. So we are looking for capital. So capital will become asset minus liability, where A is 130 and L is 50. So C will now be equal to 130 minus 50, and C therefore will be what? 80,000. So question 3, C is 80,000. Okay, question 4, we will be looking at assets again. Solution to question 4. Solution 4. Asset equals to capital plus liability, and here where C, since we're looking for A, our C is 14,000, our L is 18,000. C is 14,000, L is 18,000. Therefore A is equal to C plus L, that is 14,000 plus 18,000. Our A is 14,000 plus 18, that is 32,000. Okay. So number this is 32. Number 5, we'll be looking for capital in number 5. Number 5, we'll be looking for capital. So solution to question 5. Let's have it somewhere here. Question 5. We are looking for capital. So C equals to A minus what? Minus L, where A is 15,654 and L is 4,534. So A will become, so C is 15,654, that's 15,654 minus 4,534. So 15,654 minus 4,534. We have it as C equals to 11,120. 11,120 naira. 11,120 naira. So then question 6. So here is 11,120. Question 6, we will be looking for liability, where A is what? A is 4,000 and the capital is what? Is 3,000. So liability here is just 1,000. But let's go and work it out. Verse 6. Liability is what we're looking for. So liability equals to asset minus what? Capital, where asset equals to 4,000 and capital equals to 3,000. So L equals to 4,000 minus what? 3,000. Therefore L equals to 1,000 naira. So that is question on the accounting equation. That's question on accounting equation, and we'll be taking subsequent more question in our question and answer. Having concluded the question on the accounting equation, it is necessary that we look at the golden principles, that is the principle and practice of double entry. That has been the basis of accounting. Now the principle states that for every debit entry there must be a corresponding credit entry, and vice versa. What we mean here is that for every debit entry, a corresponding credit entry must be made. and for every credit entry there must be a corresponding debit entry as well. Now, this principle is the foundation of bookkeeping. It is the foundation of bookkeeping. And not only that, it is the foundation of bookkeeping. Experience has shown over the years that many students fail accounts due to lack of the in-depth knowledge of this principle. And this principle operates on the basis that every financial transaction must have two aspects of transaction. It is pertinent to note that this principle is propounded, is recorded in favor of an Italian mathematician known as Luca Paciolo, which he did that in the year 1494. He has paved way for the accounting method. So that principle became a very, very key. It became very, very key to report financial records, preparation of financial accounting and financial records. Now, in applying this principle, the principle view that every transactions involve two parties. So the first thing we must do is we must identify the parties to every transaction. And since the two parties are, we must have the person that is receiving. A party must be what? A party must be a receiver. There must be a receiving party or a receiver. And that receiver, we shall call that account a receiving what? A receiving account. Then we must have another party called the giver, and that giver can also be called the giving account. So that's the double entry principle recognizes that what? There are two parties to what? To every account transaction. As a result of that, we have the receiver and the giver. Now, when we'll be recording the transactions on double entry principle, it will be good for us enough to understand the principles of posting to ledger using the double entry principle. The first which we must do is that we must recognize the transactions which I've stated earlier on, that transactions in account are classified into two: the cash transactions and the credit transactions. They are classified into two. We have the cash transactions and the credit transactions. Now, the cash transactions must pass through what we call the cash book, and the final journey is what? Is ledger. And the credit transactions must pass through what we call day books, and the final destination is also what? Is also ledger. Ledger is known as the principal book. Ledger is known as what? The principal books. The principal book of accounts. And your cash book and your day books, we know them as what? As the subsidiary books of accounts. We will get there. Just take note of that. So, in recording the double entry principle, we must know the giver and we must know the what? The receiver, irrespective of what transaction it is. Is it cash transaction or credit what? Transaction. Irrespective of it, we must be able to identify who is the giver and who is the receiving party. Okay. So irrespective of the transaction, the double entry principle must be adhered to. There must be a giver and there must be a receiver. Let's look at the following steps. In recording transaction in a double entry form, although we've not had a ledger, a T account must be opened. And what is an account? An account is simply a ledger. So an account is a record that is kept for each classes of asset, income, liability, expenses in a permanent form. So an account is or what? Is a ledger. The right hand side is known as the what? Is known as the credit side. And the left hand side is known as what? Is known as the debit side. So each account is divided into two halves. The left side is known as the debit, the right hand side is known as what? The credit. And let's look at this summary. Then after you have established the two accounts involved, we must now post it into the what? Into the accounts that are open for the two accounts you have identified. The shortcut is this: every given account must be credited. That is, must be on the right hand side. The posting must be on the right hand side. And every receiving account must be what? Must be debited. The posting will be on the debit side. That is, on the left hand side. Therefore, let's just have this summary which must be memorized. Well, for example, this is an account. This is the credit side, as we said. So this is the credit side. So any posting done on the credit side is known as a what? A credit entry. But what does a credit entry indicate? Credit entry represents. What does it represent? And what does a debit? A debit entry represents. Let's deal with it what? Let's deal with it one by one. A debit entry indicates one, indicate an increase in the value of assets. A credit entry to an asset means it is a decrease in the value of assets. Let's look at liability, because these are the elements of account. 2. In the case of liability, a debit entry indicates a decrease. In the case of liability, A debit entry is a signal for decrease in the value or in the amount of liability. Indicate decrease in the amount of liability. So for liabilities, a credit entry indicates an increase in the amount of liabilities. So let's look at expenses. Expenses. What does a debit entry mean to an expenses? It means an increase in the amount of expenses, and here it means a decrease in the amount of expenses. So let's see for income. A debit entry to an income account means that there is a decrease it means a decrease in the amount of income, whereas a credit entry in income means an increase in the amount of income. So that is the summary of transactions on debit entry and credit entry.